In our strategy, we work with a 5-phase cycle framework. We are not predicting headlines. We are tracking pressure, sequencing, and confirmation. That is how we stay adaptive late cycle. This announcement moved markets fast. Equities dipped. Gold sold off sharply. That reaction tells us more than the headline itself. We are reviewing a video discussing Kevin Warsh as a potential next Fed chair. The original creator focuses on why markets reacted negatively. Our job here is to translate that reaction into our strategy framework. You should watch the original video for full context. This was not about politics. It was about expectations around liquidity and control. Markets had priced in one outcome. This announcement challenged that pricing. The core claim is straightforward. Kevin Warsh is not seen as a reflexive money printer. That surprise positioning across risk assets, and positioning unwinds quickly when assumptions break. Gold had become a hedge against Fed subservience. When that hedge weakened, flows reversed. That does not invalidate gold structurally. It resets short-term expectations. Warsh was inside the Fed during the crisis years. He supported emergency action at the time, but he later criticized ongoing balance sheet expansion, especially after crisis conditions had passed. In our strategy, this is a liquidity signal. It also touches rate policy and yield behavior. Personalities matter less than transmission mechanisms. That is where we focus. Warsh has argued that liquidity inflated assets far more than expected. Meanwhile, wages and purchasing power lagged. That gap creates fragility over time, especially late in the cycle. He has also criticized sustained low interest rates. Low rates encourage leverage and borrowing. That delays resolution but increases future pressure. This is classic policy delay behavior. Even if short-term rates fall, long-term rates may not. That is already visible in the curve. Deficits increase supply. Markets demand compensation for inflation risk. Banks do not think like households. They care about spreads, not absolute yields. They deploy other people's money. That makes regulation the real lever. If bank constraints are loosened, liquidity still flows. The Fed balance sheet can shrink. Bank balance sheets expand instead. The system stays supported through a different channel. Quick note before going further, this is educational macro analysis only. It is not financial advice. This pattern is not new. Every Fed chair eventually faces system pressure. Structure tends to override ideology. Liquidity finds a way through the system. In our strategy, this reinforces late Phase 1 conditions. Narratives change faster than structure. Pressure builds quietly underneath. That keeps Phase 2 risk deferred, not removed. Expect more volatility around policy signals. Expect repositioning across hedges. Expect uncertainty around overt Fed action. That is sequencing, not regime change. Debt levels still require liquidity. Deflation remains politically unacceptable. The system still prefers delay over reset. Optionality remains critical. If this kind of signal-based framing is useful, subscribing helps you stay oriented as conditions change. We focus on process over prediction, so you can interpret new information with context instead of noise. Watch the Fed balance sheet direction. Watch bank regulation changes. Watch long-term yields and credit spreads. Those will confirm or reject this narrative. Our strategy does not react to one-day moves. We wait for confirmation across signals. We protect optionality, and we stay adaptive. We do not need to be early. We just cannot afford to be late.